What's going on, everyone? Welcome back to the YouTube channel here. Today I'm with Kevin Fernandez. This guy's absolutely so awesome when it comes to his knowledge base, and he's been trained correctly. I love talking to this guy. The energy's always up with him. Today we're going to be breaking down a properly structured dividend paying whole life insurance policy from one of the carriers here in Canada. Also going to be comparing it to a poorly designed policy. And we are keeping in mind this is for the infinite banking concept. So we're comparing it with that concept in mind. The one that we're going to compare that's not properly structured, we're not keeping in mind like this is for insurance. We're keeping in mind more so this is for infinite banking. So we're going to be comparing both policies. Just a reminder, I don't know exactly what the age is.
2025 is the
Okay.
starting year.
So this could be designed for anyone in between, obviously starting at 18. These both have different use cases. We're comparing this for simply the infinite banking concept. Yeah, let's just get into the video. Really, really excited to have you here, Kevin.
Yeah, I'm excited to be here. So this plan here, it's 100% base plan. So all your premium is going to basically this coverage amount. Like
Yeah.
5 years in, you've put in 50,000 and you only have 10,000 in accessible cash value to show for it. But you do have this this large base amount of death benefit,
Hmm.
which this doesn't really serve the infinite banking concept, right?
Yeah. And oftentimes, I know for me at least, lots of people come in and ask for me to do a policy review, and most of the time they're putting their dollars into the policy to only the cost of insurance, which doesn't add cash value, or should I say, adds very little cash value, and that's why that total death benefit is so high on this policy here. I want to speak to the high premiums here and how it's only going to insurance rather than why would that even happen? Why is that happening?
Yeah, well, the problem here is like for someone our age, around 24, 25, you can get this amount of coverage for what, like 40, $50 a month.
Yeah, maybe
So like
less. Yeah.
most people aren't going to want to pay $10,000 to just get 1 million in coverage and not even have any accessible cash to show for that. Even you're still in the negative
Yeah.
pretty much up until
Yeah.
no, year 13 you break even. So
Anyways, so that's the poorly designed policy. The money's just going into the base premium. So you guys could see on the guaranteed value side, it's $10,000. That's the base cost of insurance. So you're simply just funding the base cost of insurance. Nothing is getting paid into the overfunded part, in which that would be growing the cash value. But as you could see, you have $672 at the end of the year. Okay. So that's just because that's the cost of insurance and that they're going to give you a dividend back on just the base cost of insurance. So if you want to flip over
yeah,
and show
one
them,
more thing
yeah,
I
go
wanna
for it.
quickly point out is with a policy like this, there's no flexibility. You have to pay 10,000 a year.
Mhm. Yeah.
There's no like minimum required annual premium, which now when we switch to the other policy, there's a smaller required annual premium
Yep.
compared to EDOs.
Yeah. So the accelerated deposit option, that's that overfunded component of the policy. And I'll just say this. If you guys want to know how insurance companies and insurance agents are paid, I should say how insurance agents are paid. They're based off that base premium. So if you see on the left side there on the guaranteed values, they're paid, I'm not going to say the exact percentage, but a percentage of that base insurance. So the people who have misaligned values with you and with most of the other industry, this is why insurance is hated on, they're going to try to sell you the largest base commission policy possible. And so with infinite banking, or another reason why a lot of people don't sell this is because they're directly impacting how much they're making on each policy. They're only selling, you know, three-fourths, no, less than that, maybe one-fourth of how much they could be making in a misstructured policy. So as you can see there, that base value is, or sorry, that base premium is $2,600 compared to 10,000. But You can fund all the way up to 10,000 in paid up additions, which significantly increases the cash value. And why does this happen?
When you use these paid up additions, you're basically buying more coverage. As you can see, the coverage is increasing. You're basically getting more permanent insurance as
Mhm.
you go. And by doing that, you're also building more cash value.
The insurance company knows that they're going to have to eventually pay out a death benefit at some point. So what they're going to do is they're going to grow your cash value to equal your death benefit at age 100. And so, as you can see, your total cash value will equal your total death benefit when you turn 100 years old. And so that's what's really growing the policy here. Obviously, dividends get paid back. So you're buying little packets of insurance that increase your death benefit. And as your death benefit increases, so does your cash value total. And so that's what's increasing the cash value year over year. And that's also helping you establish a higher dividend year over year. So your paid up additions increase how much dividends you're getting back because you're now putting more money into the policy. And so those annual dividends get reinvested to buy, and guess what? More paid up additions. And this is why it's so important to be overfunding the policy rather than just paying the base cost of 2,600. The more you could put in, the more you can get out. Another thing, last but not least, I just want to explain the guaranteed versus non-guaranteed value. So if you want to just scroll up just a tad, you can see it says guaranteed values versus non-guaranteed current dividend scale. So really what's happening here is in the financial industry, they can't say dividends are ever guaranteed, right? Though many companies in Canada have, especially mutual companies, have literally never missed a dividend payment in over 175 plus years. I just want to make sure you guys understand that they also can't guarantee that you're going to be funding that extra overfunded amount of the policy. So they really can only lock you in for that $2,600 per year on the left side there. They can't guarantee that you're going to overfund it the 7,300 there. Okay? Your only required premium is the 2665. What a lot of IBC practitioners do is they add a term rider on the policy that's convertible up to a certain year, and this allows you to convert into another whole life policy when you're ready. And that allows you to fully embrace the infinite banking concept because maybe one day you'll become uninsurable. But this will allow you to be able to convert this policy into another whole life policy if you would like, but also give you extra protection.
The good policy for infinite banking, you typically have around 80% of access to the amount you put in within the first year,
Yeah.
right?
Yeah. So the last and final closing points we want to just mention when you're looking for a properly structured whole life insurance policy for the use of the infinite banking concept, you want two things. You want a policy that traditionally, if you have a total cash value less than, I'm going to say 65% of what you put into the policy, that's getting into red light territory where you're like, I don't know if this is for me. And I totally understand because that means that the policy is not structured properly. Obviously, there's things that can hinder that. You might be a smoker, you might have health conditions. Regardless, I would really suggest getting this reviewed by an IBC practitioner, someone who specializes in these types of whole life policies. All right, guys. So if you got any value out of this, please like, comment, and subscribe. Follow me on any other social medias. You can find it in the description. But that's where you can get updates, on a daily basis. I usually am very active on those platforms. And also check out my Facebook, my insurance page, because that's where you're going to get the latest industry updates, the latest product updates. And maybe you're not just an IBC person. Maybe you want to have protection for your business. You want protection for your family. You don't even need, maybe you want investment advice. All that we can touch base on my Facebook page because that's where things are happening right now. But make sure to check out Kevin's socials. He's always posting about, the infinite banking concept. He's more of a specialist, I think, than me even right now, in terms of his niche and who he helps serve on a daily basis. But yeah, guys, hope you guys enjoyed. Take care. Have a fantastic day.